Every bull market loves to tell the same story. This time, the market never sleeps. There's always a buyer. There's always liquidity. Day or night, someone somewhere is ready to take the other side of your trade. It sounds comforting. It sounds modern. It sounds like progress. But if you've ever stared at a crypto chart at 3 a.m., you know that story can fall apart in a single candle. One moment, the price drifts quietly sideways. The order book looks healthy. Bids and asks are stacked neatly at every level. Millions of dollars, or so it seems, resting patiently just a few ticks away. Then, in the span of 60 seconds, a single red candle plunges straight down like an elevator cable snapping. Hundreds of millions in market value evaporate. Liquidations detonate. Stop losses fire like dominoes. And when the panic ends and you finally look at the order book, it feels like walking into a party after the lights come on. The music is off. The crowd is gone. All that's left is the mess. No major news broke. No war was declared. No exchange was hacked at that exact moment. The only thing that changed was time. The clock rolled past midnight into that strange silent hour when most people sleep, and only algorithms, insomniacs, and the deeply obsessed are still watching. The question is simple, and it cuts through every flashy interface and every confident slogan. Where did the liquidity go? To answer that, it helps to strip the word liquidity of its mystery. It gets used like a spell in financial circles. Liquidity sounds like a natural resource, something that just exists as long as markets exist, like air surrounding a planet. But liquidity is not a law of nature. Liquidity is a behavior. It is the willingness of other people to take the other side of your trade at a price you find acceptable. That willingness can surge in good times and vanish in bad ones. It can look deep and solid when you don't need it and turn into smoke the instant you do. On a screen, liquidity is represented by an order book. At each price level, there are resting orders. People willing to buy if the price drops to a certain point. People willing to sell if it rises. The last traded price is just a tiny dot between two cliffs of intention. That picture can be deceiving. It looks like safety. It looks like a ladder you can walk down or up at any time. But those bids and asks are not promises carved in stone. They can be canceled in microseconds. They can be pulled the moment volatility appears. They can be there one moment and gone the next. History doesn't use order book charts or candlesticks, but it tells the same story. In 1907, New York financiers believed there would always be someone to roll over their short-term funding. The banks extended credit freely and expected it to be renewed. Then, almost overnight, confidence broke. Lenders decided they would rather hold cash than extend new loans. Funding dried up. Perfectly solvent institutions found themselves trapped, not because their assets had disappeared, but because their ability to turn those assets into cash had. Liquidity hadn't just slowed, it had snapped. In October 1987, stock markets around the world fell in unison. One of the accelerants was a clever innovation called portfolio insurance, an automated strategy that sold increasingly as prices fell. The idea was simple. If markets drop, sell futures to hedge losses. Individually, that sounded protective. Collectively, it meant that when prices began to decline, a wave of automatic selling crashed into an already fragile market. Bids disappeared. The insurance itself became the fuel for the fire. Again, the pattern was clear. As volatility rose, the very actors who were supposed to provide liquidity stepped back or turned into forced sellers. Crypto operates with different technology and a different culture, but it dances to the same rhythm. The market never closes, but human attention does. During peak hours, institutional traders, market makers, and retail investors all participate. Spreads are relatively tight. Depth looks reassuring. But as night falls in major financial centers, something subtle happens. Large trading desks scale down. Discretionary traders log off. Some algorithmic strategies reduce size or widen their spreads. The apparent depth begins to thin. At the same time, another force remains very much awake: leverage. Crypto thrives on it. Perpetual futures, margin trading, borrowing against collateral, stacking positions 10 times or more the size of actual capital. On a calm day, leverage makes small moves feel exciting. On a chaotic night, it makes normal moves feel like catastrophe. Every leveraged position comes with rules. When the value of collateral falls too far, the exchange or protocol doesn't send a gentle message asking for a plan. It liquidates. Protection comes first for the system, not the trader. Now imagine the typical setup leading into a 3 a.m. event. A coin has risen over days or weeks. Traders have grown confident. Many are leaning long with borrowed money. During the day, thick bids below the price conceal the danger. Then night comes. Liquidity providers step back slightly to reduce risk. Depth that looked like an ocean is now closer to a large pond. Nothing seems wrong yet. The candles look small. Volatility looks tamed. Then a single large sell order hits the book. Maybe it's a fund rebalancing. Maybe a whale is exciting. Maybe it's the first wave of liquidations from someone who overextended. That market sell begins to chew through the top bids, pushing price down. As it moves, it crosses the levels where traders have placed stop losses. Those comforting instructions to the exchange that say, if the price falls this far, just sell me out. When those stop losses trigger, they don't politely line up. They smash into the book as more markets sell. Now the wave is bigger, the price drops faster. As it falls, it pushes leveraged positions into danger zones. Margin ratios, once safe, suddenly look tight. The liquidation engines notice. Automatic systems start closing positions, dumping collateral into a market that is already under stress. The wave grows again. At this point, the liquidity that once looked stable begins to flinch. Algorithmic market makers track volatility, order flow, and risk. When the speed of the move exceeds their tolerance, their only protection is to step back. They widen their spreads, pulling resting orders away from the falling price. Some shut down quoting altogether for a moment. They are not obligated to lose money just to maintain the illusion of a smooth market. From a distance, this chain reaction appears as a violent wick. Price plunges into a distant zone, far below where it traded just minutes before, then rebounds. To those who were stopped out or liquidated, it feels like sabotage. To those waiting with low bids deep below the market, it feels like an opportunity. They had the patience and the capital to place orders at painful levels and let panic bring the market to them. For everyone else, it is a reminder that liquidity is generous in slow motion and cruel at high speed. These events are not mistakes in the system. They are the system. Leverage, fear, automation, and thin depth at odd hours combine into a machine that can destroy overconfidence in a single night. Crypto winter makes all of this more brutal. In a euphoric bull phase, liquidity seems infinite. Exchanges compete to list new tokens. Makers compete to provide tight spreads. Volume attracts more volume. Stories of overnight fortunes draw in waves of newcomers. During those phases, almost anything can be sold at almost any time. The illusion of permanence grows. People begin to think of exit as a right, not a privilege. The belief forms quietly. Even if this is risky, I'll get out when I need to. Winter rewrites that belief. Participation drops, volume shrinks, risk appetite collapses, market makers narrow their focus to a few strong pairs and scale down in everything else. Projects that traded millions daily now see only a trickle. Order books become patchy. Islands of liquidity form around the largest, most trusted assets, while the rest of the landscape dries out. This is not unique to blockchains. During the dot-com bust, once beloved tech stocks saw their daily volume vanish. In the years after the 2008 crisis began, complex mortgage securities that once seemed effortlessly tradable turned into dead weight on bank balance sheets. Buyers disappeared. The securities still existed. Prices could still be quoted on paper. But practical liquidity, the ability to exit quickly at a sane price, was gone. Crypto compresses these cycles. What took months or years in previous eras can sometimes play out in days or even hours. A project can go from darling to abandoned in a week. A token that seemed to embody a narrative of the future can become nearly unsellable once faith breaks. The machinery doesn't care about the story. It responds to order flow, risk, and fear. When liquidity vanishes, three forces tend to determine who suffers and who survives. The first is the nature of the assets held. In every crisis, capital retreats toward whatever is seen as safest and simplest. In traditional markets, that might mean cash and short-term government bonds. In crypto, it often means the biggest coins or supposedly stable anchors. Even then, trust is not guaranteed. When stablecoins wobble or centralized promises are questioned, the definition of safe can change overnight. Still, the broad pattern holds. Complex, illiquid, obscure tokens bear the brunt of selling pressure, while a smaller set of assets absorbs the remaining belief. The second force is leverage. Leverage is silent when prices move gently upward. IT speaks loudly when they fall. A trader without leverage can choose whether to sell in a panic. A trader with heavy leverage often has no choice at all. Margin calls and liquidation engines act mechanically. They do not listen to long-term theses or hopes of recovery. Positions are closed to protect counterparties, not individual feelings. In a 3 a.m. cascade, the difference between modest and excessive leverage can be the difference between a sleepless night and a wiped-out account. The third force is position in the hierarchy of the market. Throughout history, crises have transferred wealth from the many who were forced to sell to the few who were prepared to buy. Those who hold dry powder, who are not overexposed and who understand the mechanics in advance, are able to step in when fear is highest. They do not control the timing of the panic, but they control whether they will be victims of it. In every great unwind, someone is on the other side of forced selling, collecting assets at prices no one imagined just weeks before. There's a harsh lesson running through all of this. Market participants do not control when other people panic. They do not control when liquidity providers retreat. They do not control when exchanges choose to protect their own balance sheets through aggressive liquidations. They only control their own exposure to those events. The comforting idea that one can always get out if things get bad is one of the oldest illusions in finance. It assumes that personal decisions exist in a vacuum, independent of everyone else trying to make the same move at the same time. In reality, exits are narrow. When many try to squeeze through simultaneously, the crowd itself becomes the danger. Crypto's late-night candles are just visible, accelerated reminders. Similar dynamics have played out in sovereign debt crises, housing busts, emerging market collapses, and stock market panics. Technology changes, the exchanges change, the products change, the underlying pattern does not. When confidence is high, liquidity brags. When confidence breaks, liquidity hides. The deeper warning lies beneath every chart. If a plan relies on being able to exit quickly at a fair price during chaos, it is not a plan. It is a hope. A more realistic approach asks a harsher question. What if the only exit available comes at the worst possible level, at the worst possible time, when screens are red and order books are hollow? The quiet hours of the night expose assumptions. At 3 a.m., there are fewer eyes watching, fewer hands on keyboards, fewer risk managers actively adjusting. Yet the code that governs liquidations and stops is indifferent to time zones. It will execute whenever the conditions are met. Markets truly do trade every second. That does not mean they trade fairly for everyone in every second. Crypto winter amplifies the test. In those seasons, optimism is gone, narratives are tired, and the crowd that once cheered every new listing has moved on. What remains is a leaner, more cautious, more easily spooked group of participants. In that environment, the same amount of selling can move prices much further. The same rumor carries more weight. The same wick cuts deeper. It is tempting to view these events as distant, as something that happens only to gamblers or reckless speculators. History suggests otherwise. Many of the people hurt in past panics thought of themselves as prudent. They owned what was fashionable, popular, or recommended. They believed in the ability to react if needed. They underestimated how quickly needed can arrive when liquidity is an assumption instead of a condition. The choice, then, is not between volatility and stability. Volatility is part of every free market. The real choice is between blind trust in constant liquidity and sober awareness of its limits. Awareness does not eliminate risk, but it changes behavior. It encourages position sizes that can survive sudden air pockets. It discourages leverage built on the fantasy of flawless exit. It respects the fact that markets are not obligated to offer graceful, orderly paths to safety. Every 3 a.m. candle is a reminder written in price. It says that markets serve their own logic first. They will happily move with grace while the crowd is calm and then snap without warning when conditions align. There is no fairness clause that prevents that. There is no guarantee that the level one imagines as a worst case will actually hold when everyone rushes there at once. When liquidity vanishes in the dead of night, the event feels dramatic, even supernatural. In truth, it is the sum of very human tendencies. Overconfidence in good times, reliance on leverage to amplify gains, herd behavior in panic, and a tendency for risk takers to retreat at the first sign of real danger. Algorithms and protocols only codify those tendencies into faster, more mechanical reactions. The lesson is not to fear every candle or to hide from every market. The lesson is to recognize that liquidity is a fair weather friend. It is generous in the sunlight and fickle in the dark. It rewards those who respect its limits and punishes those who build their entire strategy on its eternal presence. Every crisis, whether in traditional finance or in crypto, is a transfer. From the many who trusted that the door would stay open to the few who understood it, might slam shut without warning. From those holding paper promises that depend on constant liquidity to those holding positions sized for survival. From those who confuse a busy market with a safe one to those who see activity as a surface, not a foundation. When the next strange wick appears at 3 a.m., the charts will tell only part of the story. Behind the pixels will be the same forces that have always shaped financial history: fear, leverage, retreat, and opportunity. The difference between being swept away and staying standing rarely lies in predicting the exact moment of the move. It lies in never forgetting that liquidity is not a right, but a condition that can disappear exactly when it is needed most.